Does the Federal Reserve need to cut rates in order for mortgage rates to come down? Now, on the surface, this question may seem like a simple yes. The Federal Reserve cuts their rates, which will bring mortgage rates down. But the answer is actually much deeper than that. This is really important for both home buyers and home sellers to understand. Because if you're a home seller right now, there aren't many buyers out there looking for your property. Not many people can afford to purchase homes at these prices with these interest rates. So if mortgage rates come down, that will bring more buyers into the housing market who can potentially purchase your home. And if you're a home buyer out there, lower mortgage rates mean that you can either purchase a more expensive property or your monthly payment at the same price property will be lower. So it's very impactful for the housing market on both the buy side and the sell side. Now, on this channel, we talk a lot about economic factors that move the mortgage market and move the 10-year treasury market, right? Low inflation numbers tends to bring mortgage rates and the 10-year treasury yield down, which is positive news for the housing market. But what we haven't talked much about is the spread between the 10-year treasury and the 30-year fixed rate mortgage. Right now, that spread sits at about 2.3%, where the 10-year treasury is at around 4.6%. The 30-year fixed rate mortgage is at around 7%. So we're looking at a 2.4, 2.3% spread between the 10-year treasury yield and the 30-year fixed rate mortgage, which might not mean anything to you watching this video. But when you take a look back at the 2010s, so 2010 through 2020, the average spread between the 10-year treasury and the 30-year fixed rate mortgage sat at around 1.5%. So we're almost a full percentage point higher than where we were the previous decade. So if we take this into account and we figure out what factors are impacting this spread, we have an idea of what can move mortgage rates further down without the Federal Reserve even dropping their rates, right? If we see that spread come from 2.3, 2.4% above the 10-year treasury down to about 1.5%, I mean, that's almost a full percentage point decrease in mortgage rates right there without the Federal Reserve doing anything. So in this video, we are going to discuss the factors that impact the spread between the 30-year fixed rate mortgage and the 10-year treasury to help you understand what factors can drop mortgage rates as we move through 2025 without the Federal Reserve doing anything. Before we get into it, my name is Liam O'Reilly. I'm a realtor in Vermont with Jerry Riley Real Estate. If you have any real estate needs, whether in Vermont or anywhere across the country, reach out to me directly. I would be happy to help you. All of my contact information is in the description for you. So let's switch gears here and take a look at where the 30-year fixed rate mortgage is and where the 10-year treasury is. Okay, so right here, we can see that the 10-year treasury is at 6.17% as of yesterday, the 24th of January. We see 6.17%. When we take a look at the average fixed rate mortgage, this is from the 23rd of January. It sits at just under 7%. Now, this isn't the best mortgage rate you can get. If you have better credit and you have a high income, you might be able to get lower than the lower than the 7% mortgage. But this spread is what we're talking about. The difference between the average 30-year fixed rate mortgage and the 10-year treasury. So we're looking at over a 2% spread, roughly 2.3, 2.4%, somewhere in that range for between the 10-year treasury and the 30-year fixed rate mortgage. Now, if we hop over to this article here, out of Brookings, it breaks down this spread between the 30-year fixed rate mortgage and the 10-year treasury. Now let's take a look at this first highlighted section here. But the increase in the 30-year fixed rate mortgages, particularly from early 2022 through late 2023, has been unusually large relative to the rate of long-term treasury securities, which may suggest that mortgage rates are being pushed up by more temporary factors. In other words, mortgage rates are higher than what they should be because of this spread between the 10-year treasury and the 30-year fixed rate mortgage. Looking at most recent data, we find that some of those temporary factors are unwinding. So that spread is starting to come back down to the historical average because those factors are unwinding. And if those factors continue to unwind and long-term treasury rates continue to decline, mortgage rates would also see further decline. So, we talk a lot about on this channel what is impacting the 10-year treasury because that directly impacts mortgage rates. But this spread might even be more important right here. Waning those factors has been partly offset by one factor that pushed the spread up more in recent months. an increase in the premium lenders are charging borrowers over the rate those lenders are effectively paying for the cost of those funds. So that sentence is a little complicated, but what these lenders do when they originate a loan is they charge you a higher interest rate than what they sell on the secondary market into the mortgage-backed security. So that's the premium between where the mortgage-backed security return is, the rate that these investors who are investing in mortgage-backed securities, the rate of return they're getting on their money, and what the lender is charging you as the borrower. So you, as a home borrower, and myself as a home buyer, any home borrower out there in the market pays a higher interest rate because of the loan origination process, and that's how the lenders make their money. Whether they're a bank, whether they're a uh, credit union, or whether they're a lender out there like Rocket Mortgage, or here in Vermont, like Vermont Mortgage Company, they make their money off of that spread. And we're seeing an increase in that spread. So when we scroll down, they have some very interesting charts here. Um, the peak was at 2.96%. So we see this spread, and this is what they're talking about, the unwinding between the spread. This chart is a spread between the 10-year Treasury and the 30-year fixed rate mortgage. The highest point previously, before the 2020s here, was back in 2009 when it hit 2.91 percentage points. So the 30-year fixed rate mortgage was almost 3 percentage points higher than where the 10-year Treasury was. In 2023, the 30-year fixed rate mortgage was even higher than it was in 2009, still at around that 3 percentage point mark. And that's what we're talking about here. We're talking about the spread between the 30-year fixed rate mortgage and the 10-year Treasury. Now we see that spread has declined as we move throughout 2024. This article was written in October of 2024, so we're looking at September data. Now, it's not the most recent data, but in September it was at 2.46. And we can see here by these charts, it's shrunk even further to around 2.3%. So what goes into this spread? Now, when we take a look at this chart here, they break down the spread and what they assume is causing the difference between the 10-year Treasury and the 30-year fixed rate mortgage. We see this primary secondary spread. That's what they're talking about in terms of lenders. This blue shaded area accounts for the majority of the difference between the 10-year Treasury and the 30-year fixed rate mortgage. So this premium that lenders are charging is causing a significant increase in mortgage rates right now. And the reason why they're charging that increase is because there's a higher risk that when you lock in your mortgage rate while you're under contract for 30 days or 60 days, whatever it may be when you're purchasing a property, that there's a higher chance that mortgage rates will fall. So if mortgage rates fall while you're under contract, that's not good for the lenders. You could go find another borrower. There's more risk on their side. And so they're charging a premium for that. Now, at the same time, well, actually, before we move on to the next section, we take a look back in 2005, we see that the premium that lenders were charging was much, much lower. And then as we move through the 2010s, it kind of peaked up here, and we're seeing that continue throughout 2020. Now, when we take a look at the next section here, the prepayment risk, this is what I think has the most potential to cause mortgage rates to fall further and fall quicker in 2025. So this prepayment risk, basically what this is when you purchase a property, most people hold on to their mortgages for an average of 7 years before either selling their home and paying off their mortgage or refinancing into a lower rate. But because we're at the top of the rate cycle right now, and rates are likely to go down moving into the future, there's a higher chance that people taking out mortgages right now will refinance or sell their home moving into the future. And so that's why this green shaded area is so large. It's so large because the investors in mortgage-backed securities are taking on additional risk that the loan won't reach maturity, that people are going to sell or refinance their property, as you probably should. If rates go from 7% down to 5% or even lower, it's probably a good time to refinance and get a lower monthly payment, but it's not good for the investor in the mortgage-backed security. And that's part of the reason why mortgage rates are so high right now, is because there's such a high chance that rates will move down moving into the future. Maybe not this year, but at some point within the next 5 years. And the mortgage market is charging a premium because of that risk. Now, the purple, and I have it highlighted here right at the top, the remaining spread, which reflects the changes in demand for mortgage-related assets after adjusting for prepayment risk. So what that purple is how much demand are there for mortgages on the secondary market. And we see here in 2021 and in 2020, 2013, that actually caused negative pressure on mortgage rates. In other words, there was a ton of demand for mortgage-backed securities back in 2021 and 2020. And if you remember, that's when the Federal Reserve was purchasing a ton of mortgage-backed securities, which drove the rate down even further. So there was a ton of demand for mortgages because people were looking for a safe place to put their money with a decent rate of return. Even though mortgage rates were relatively low, it's still a safe, stable asset that had a higher rate of return than what was available at that time, which drove mortgage rates down. Now we see back in the early 2000s, there was almost no demand for the 30-year fixed rate mortgage. I mean, there was some demand, but much less than we had today. We can see there's still a lot of demand for 30-year fixed rate mortgages. And so that's sure, it's impacting the mortgage rate. But without the Federal Reserve stepping in and actually purchasing mortgage backed securities, I don't think we're going to see a big difference in that spread. So the biggest thing here is the primary and secondary spread and the prepayment risk. Now, will we see those things move down as we move throughout 2025? What I think will happen is as mortgage rates start to come down, and the lower that mortgage rates get, the lower that both the primary and secondary spread and that prepayment risk that is causing mortgage rates to be higher than the historical spread has been, those are going to start to shrink. So as we receive more positive economic news, we will likely see mortgage rates fall, and we could see mortgage rates fall faster than the 10-year Treasury. So in other words, we could see mortgage rates fall quickly, quicker than expected in 2025 or maybe 2026, whenever mortgage rates start coming down, because there's going to be less prepayment risk, right? People, if mortgage rates are at around 5%, the risk of a refinance in 7 years is going to be much lower. And if rates are at around 5% and they seem like they're staying at around 5%, the primary secondary spread can be lower because there's less risk of lower interest rates moving into the future. So I hope you guys got something out of this video. This is very insightful for me to learn about this spread and understand what is going on in the mortgage market, what's causing mortgage rates to stay high, and why they could decrease quickly in the future, even if the Federal Reserve doesn't cut their rates. Let me know what you think about it. Leave a comment. I love hearing from you, and I'll see you in the next video.